Welcome to a new deep dive. Today, we're pulling back the curtain on the first quarter 2025 financial results from Star Bulk Carriers.
Yeah, quite a bit to unpack from their conference call.
We've got a stack of insights here, everything from the hard numbers on their performance and operations, right, to how management sees the dry bulk market shaping up and what they're saying about those big picture regulatory changes hitting the shipping world.
Think of this as your essential briefing, really. Our mission is to extract the most important nuggets for you so you walk away understanding what Star Bulk reported, how they're sort of navigating things, and what they're keeping an eye on.
Yeah, exactly. Let's unpack this call and really dig into what Star Bulk shared about their performance and outlook. All right, let's start right at the top with the snapshot of their first quarter results. What were the headline numbers?
Well, the company reported a net income of $0.5 million for the quarter, but on an adjusted basis, they actually showed a net loss of $7.8 million. That translated to an adjusted loss per share of about 0.07. And adjusted EBITDA for the quarter came in at $49 million.
Okay, so an adjusted loss for the quarter. Yet, despite that, management was pretty active on a capital return front.
That's one of the key takeaways, I think, right off the bat. Even with that adjusted loss, they repurchased 1.3 million shares for just under $20 million, 19.6 million specifically.
Right.
And they declared a dividend of 5 cents per share. What's interesting here is their dividend formula, it wouldn't have technically required a payout this quarter.
So they chose to do it anyway.
Exactly. Management really highlighted this decision, framing it around, continuing to prioritize returns to shareholders and pointing to the company's overall financial strength.
Speaking of which, what does the balance sheet look like? How are they positioned financially?
Pro forma total cash stands at $437 million. Total debt is sitting at $1.2 billion. They also noted they have an additional $50 million available through a revolver facility, which brings their total pro forma liquidity close to $500 million. Pretty solid.
And there's got some serious unencumbered assets backing things up too, correct? Assets without debt?
Absolutely. They point out they have 13 vessels that are completely debt-free with an aggregate market value sitting around $270 million. So that adds another layer of flexibility.
Now, let's look at the daily operating figures. What was their average time charter equivalent or TCE rate for the fleet?
The TCE rate averaged $12,439 per vessel per day in Q1.
Okay.
And when you factor in their combined daily operating expenses, that's OPEX, and their net cash GNA expenses, that came to $6,217 per vessel per day.
So essentially their TCE, less those core running costs, OPEX and cash GNA, was roughly, what, $6,220 per day? Still a positive spread there.
Correct. Which leads nicely into their commentary on the Eagle Bolt transaction synergies.
Right, the big acquisition.
Yeah, since that transaction closed back in April of 2024, they've achieved almost $40 million in cumulative synergies just from the integration.
Wow.
And they stated the integration process across departments is now complete. So that's done.
Okay, let's maybe dig a little deeper into that capital allocation story you mentioned earlier.
Right.
Management really laid out their strategy over the past, 3 years?
Yeah, this is where you see the longer term picture. They emphasize that since 2021, they've taken actions totaling a massive $2.6 billion. Billion returned to shareholders through dividends and buybacks and also through debt repayments. They very clearly framed this as, value creation for shareholders.
And during that same period, they've also been strategically growing the fleet, often through these larger buyouts. Seems counterintuitive almost.
Well, yes, but strategically, they've done consecutive fleet buyouts specifically structured by issuing shares when they felt the shares were trading at or, ideally above their net asset value, their NAV.
So accretive growth.
Exactly. That allows for growth without diluting value at the wrong times. Smart way to do it if you can time it right.
There was a pretty striking point about debt reduction too, wasn't there?
Yes, very striking. They showed the evolution of their net debt per vessel. Since 2021, that figure has dropped from $11.6 million down to just $5.4 million per vessel.
That's huge.
It's a reduction of over 50%. And what's particularly noteworthy, they stated their current net debt position is actually covered by the fleet's scrap value alone.
Covered by scrap value. That's quite a safety net.
It tells you a lot about their financial de-risking efforts over the last few years.
That's a pretty strong position to be in. They also walked through the cash flow for this specific quarter, right? How the cash moved.
Yeah, they did. Started Q1 with $441 million in cash. generated $49 million from operating activities.
Okay, positive ops cash flow.
Right. Then, after accounting for debt service, capital expenditures like those energy-saving devices and ballast water systems they're installing.
And environmental upgrades.
Exactly. Plus proceeds from vessel sales, the share buybacks we mentioned, and paying out the prior quarter's dividend. They ended the quarter with $437 million.
So despite that adjusted loss we mentioned right at the start, the core operational cash flow was positive, allowing them to keep a relatively stable cash position even after the buybacks and the dividend.
Exactly. The underlying business generated cash from its operations. That's key.
All right, switching gears a bit from the money side to how they're actually running the ships, they provided an update on those Eagle Bulk integration savings on the operational side, didn't they?
They did. They continue to see savings on operating expenses from, blending the two fleets and practices. The consolidation of ship management practices is complete now.
Okay.
A key point they highlighted is the expected phase out of third-party crew managers. That should happen by Q3 this year.
Bringing it all in-house.
Right. They're shifting entirely to their own in-house crew platform, which they expect will lead to further optimization. I mean, this involves managing a crewing pool of over 5,000 seafarers directly. It's a big undertaking.
Wow, 5,000. What were the specific savings numbers they could point to for Q1 from the Eagle Bulk side?
For Q1, they estimated the operating expenses and GNA savings for the former Eagle Bulk fleet stood close to $2,040 per vessel per day.
That's significant.
It is. And additionally, just leveraging their larger scale, they reduced dry dock costs for that same former Eagle Bulk fleet by $8.6 million in Q1 alone.
Okay.
Plus, they've also accumulated interest expense savings from refinancing Eagle Bulk's higher cost debt. So adding it all up, total cost synergies for Q1 were pegged at $18.4 million.
And they gave their overall fleet operating expense number for the quarter, the blended rate.
Yes, the operating expense for the total combined fleet in Q1 2025 was $4,898 per vessel per day. Net cash GNA was $1,319. They also made a point of mentioning they rate highly in safety scores compared to other listed peers, which is an operational benchmark they clearly track and value.
Good to know. They also gave us a forward look on dry docking, which is always a significant operational expense and impacts available days.
Yeah, for the rest of 2025, they estimate dry dock expenses of about $47 million, covering 38 vessels.
Okay.
They expect this will result in approximately 1,210 total off-hire days across those ships.
And they mentioned timing that strategically.
Yes. They specifically noted they've kind of front-loaded many of these dry docks into the first half of the year.
Yeah.
The idea is to minimize off-hire time later and potentially leverage market seasonality in the second half, hoping for stronger rates then.
Makes sense.
Yeah.
And capital expenditure beyond just dry docks. Any other major spending?
Their CapEx schedule includes some payments for new buildings and those ongoing energy efficiency upgrades we touched on.
Yeah.
They have 5 new Kammax vessels expected for delivery in the first half of 2026. And they've already secured $130 million in debt financing for those particular ships.
So they're clearly continuing with the environmental upgrades on the existing fleet as well, not just the new builds.
Oh, yeah, absolutely. In line with the IMO regulations, they're actively investing in operational technologies and fuel efficiency measures across the board. They said they've completed 42 retrofits so far to add energy-saving tech.
42 already done.
With another 21 planned just for the remainder of 2025. So it's an ongoing program.
On the fleet composition side, they've also been selling off some vessels, haven't they?
Correct. They mentioned they're opportunistically disposing of older, less fuel-efficient vessels, specifically the non-eco types.
Getting rid of the gas guzzlers.
Pretty much. The goal is to reduce the average age of the fleet and improve overall efficiency. In Q1, they agreed to sell some older Supermax vessels. Then, in Q2, they agreed to sell even more Supermaxes.
Okay.
Expecting aggregate net sale proceeds of about $38.6 million from all these recent sales, anticipated to be fully received in Q2 and Q3 of 2025.
So how does this affect their overall fleet size and profile after the Eagle Bulk integration and the sales?
Well, following that integration and considering the new builds on order on a fully delivered basis, they will operate a fleet of 150 vessels.
150, that's massive.
It is. The average age is about 11.9 years, making them one of the largest dry bulk fleets among their U.S. and European listed peers. Big scale.
Okay, now, this is where it gets really interesting, I thought. Management spent a good chunk of time on the regulatory front, specifically diving into the IMO's new net zero framework.
Right.
What did they say about that?
Yeah, this is a major development for the whole industry, aiming for climate neutrality by 2050. This new framework introduces a greenhouse gas fuel intensity metric.
Okay.
Ships will have to report their intensity annually, kind of similar to an existing regulation, the CII. But this one looks different. There are 2 tiers of targets being discussed, a base target and then a more stringent direct compliance target that ramps up over time.
And there's a system built in for compliance and potential penalties or incentives, like a market mechanism.
Exactly. Ships that have a compliance surplus, meaning they outperform the target, can apparently transfer or bank those surplus units.
Okay, so credits.
Right. Conversely, those with a deficit, ships that don't meet the target, can potentially use surplus units from others, or they might have to purchase what they called remedial units from the IMO itself at a set price per ton of CO2 equivalent deficit.
A set price. Do they mention numbers?
Management noted the price structure discussed was something like either $100 or maybe $380 per ton, possibly depending on the level of the deficit. Still details to be confirmed, I think.
And where does the money collected from this penalty system
go? Good question. The profits generated from this regulation are intended to go into a new IMO net zero fund. And part of that fund is planned to be circulated back to the industry, sort of as a reward or incentive for companies using near zero or zero emission fuels.
Okay, so recycling the funds back into green solutions.
Yeah.
When is this framework actually set to take effect? It sounds complex.
Adoption is expected or targeted for October 2025, though that's subject to final approval, of course.
Right.
The first reporting period under the new framework would then likely start on January 1st, 2028, so still a few years out. Star Bulk just stated they remain focused on understanding the requirements fully and finding the optimal strategies for timely compliance. Watching closely.
Okay, let's shift from regulations, important as they are, to the broader market outlook they presented, maybe starting with the supply side of the equation. What's happening with fleet growth?
Right. On the supply front, they reported that in the first 4 months of 2025, net fleet growth was about 11.1 million deadweight tons. That works out to roughly 2.9% year-on-year growth.
How's that broken down?
That was from 12.2 million tons delivered, so new ships hitting the water, offset by only 1.1 million tons demolished or scrapped.
Not much scrapping.
No. And the new building order book remains quite modest, historically speaking, at only 10.3% of the existing fleet size. In fact, new contracts placed in Q1 were apparently at an 8-year low.
What are the main factors keeping new orders so low, according to their view? Why aren't owners rushing to build?
Well, a few things. They pointed to limited shipyard capacity. Most major yards are booked out until late 2027.
Can't get a slot.
Pretty much. Plus, high building costs are a significant factor right now, and there's still considerable uncertainty among owners about which future propulsion fuels will become the standard, methanol, ammonia, LNG. No one wants to bet wrong on expensive new tech.
Makes sense. They also highlighted the aging nature of the current fleet, didn't they?
Yes, this is a critical point on the supply side. By the end of 2027, they project roughly 50%, half of the dry bulk fleet will be over 15 years old.
Half the fleet over 15.
Yeah. And they estimate that the increasing number of vessels needing to undergo their third special survey, which is a major costly checkup, will reduce effective capacity by about 0.5% annually between 2025 and 2027, just due to the extra time ships spend off hire in the shipyard for that survey.
What about operational factors affecting the available supply? Things like steaming speed or port congestion?
Good point. Average steaming speed actually hit a record low of 10.8 knots back in February.
Wow, slow.
Very slow. This was largely driven by softer freight rates at the time, high bunker fuel costs, and importantly, those environmental regulations incentivizing slower speeds to save fuel and cut emissions.
Did speeds recover?
Well, speeds did rebound slightly more recently with better earnings and lower oil prices, but they remain below last year's levels overall. And management expects these new carbon regulations to continue incentivizing slow steaming, at least in the medium term.
And congestion.
Global port congestion kind of normalized in late 2024 after being quite high. But in Q1 2025, loading port congestion actually increased due to weather issues, while Chinese discharge port congestion fell to historic lows, mainly because their import volumes were down.
So what's the outlook for congestion?
For the rest of 2025 and 2026, they anticipate congestion levels will probably be neutral or maybe slightly positive for the supply-demand balance, mostly following typical seasonal patterns rather than being a major driver like it was a couple of years ago.
Okay, now let's flip to the demand side of the picture. According to the sources they cited, Clarkson's, I believe, total dry bulk trade is actually projected to contract in 2025. That sounds concerning.
That's right. The projection they shared is for a contraction of 1.2% in terms of tons shipped and 0.4% in ton miles. And this follows 2 pretty strong years of growth, so it's a shift.
What's influencing this projected contraction? What are the headwinds?
Well, they mentioned uncertainty stemming from President Trump's ongoing tariff negotiations and potential policy shifts globally. International agencies had previously lowered global GDP and trade projections following some unspecified events, like a Liberation Day event mentioned cryptically.
Okay.
For example, the IMF revised its 2025 global growth forecast down to 2.8% from 3.3% previously. They lowered the U.S. forecast significantly to 1.8% from 2.7%, and China's forecast down to 4% from 4.6%, so downward revisions across the board.
However, management added a bit of a maybe optimistic caveat there.
Yes, they did. They noted that upward revisions to those forecasts could now potentially be expected, specifically after a U.S.-China trade agreement was apparently reached recently in Geneva. That's a new positive variable that wasn't in the earlier forecast.
Right, a potential game changer. Looking at Q1 2025 specifically, how did demand actually fare?
Total dry bulk volumes year on year were actually supported by relatively strong bauxite and minor bulk shipments. So those did well.
Okay.
However, the combined volumes for the big 3 iron ore, coal, and grains actually declined by 3.5% year on year in Q1. So the majors were down.
And the Suez Canal impact.
Still significant. They noted that Suez Canal crossings are still only around 50% of the levels seen before the Houthi attacks started, and they expect Red Sea passages to be slow to restart fully. That adds voyage time, which supports ton miles, but signifies disruption.
Now, China's economy exceeded expectations in Q1. We heard that a lot. How did that translate into their dry bulk imports? Was it a direct correlation?
Interestingly, no. China's GDP did grow 5.4% in Q1, which was better than expected, yeah. And this was fueled by aggressive stimulus measures put in place since September 2024, plus increased retail sales, industrial production, exports.
Sounds positive.
But their dry bulk imports actually contracted by 8.3% year on year in Q1.
Why the disconnect?
Primarily driven by the elevated inventories they built up previously, and also robust domestic production within China during 2024, especially for things like coal. So they just didn't need to import as much in Q1.
What about the rest of the world outside China? How did their imports look?
That was the brighter spot. Dry bulk imports from the rest of the world actually expanded by 4.5% year on year.
Okay, decent growth.
Yeah, attributed to lower commodity prices, making imports more attractive, maybe some easing monetary policy in certain regions, and potentially companies preemptively stockpiling ahead of anticipated U.S. tariffs.
Where did that growth come from mainly?
Mostly from developing Southeast Asian nations and the Middle East. European imports also showed an increase since the middle of 2024, so broader growth outside of China.
Let's maybe break down the projections they offered for 2025 demand by commodity. First, iron ore. The big one.
Iron ore trade is projected to contract slightly by 1.3% in tons and 0.6% in ton miles for 2025 overall.
Okay.
China's steel production actually increased slightly in Q1, helped by exports and lower input costs for them. But management noted future output could be curbed by government efforts to control production, plus rising global protectionism trends against Chinese steel exports.
And Chinese iron ore imports.
Expected to gain support later in the year, potentially, as their current high stockpiles decline and their domestic iron ore production, which fell in Q1, possibly stays lower. So maybe a second half recovery there.
And specifically on ton miles for iron ore. Anything interesting there?
Yes, they see potential support for iron ore ton miles, particularly from late 2025 onwards. This is tied to new high-grade Atlantic mines like in Guinea starting operation.
Longer voyages.
Exactly. This higher quality ore often comes from further away and could potentially replace some lower quality Chinese domestic production, increasing the average voyage distance and thus ton miles.
Okay. How about coal trade projections for 2025?
Coal trade is projected to contract more significantly by 3.2% in tons and 3.6% in ton miles in 2025. This follows, remember, record import levels in 2024.
Right, tough comparison.
Yeah. Chinese and Indian imports contracted sharply in early 2025. Why? Robust domestic production in both countries and reduced thermal power generation needs. Plus, rising renewable energy sources and high existing inventories add downside risks to this sector globally.
Is there any support for coal demand elsewhere? Or is it all negative?
There is some support. They expect strong demand continuing from Southeast Asia, which should provide some cushion for overall coal trade over the next year, partially offsetting declines elsewhere.
Got it. Grain trade, what's the outlook there?
Grain trade projections are interesting, projected to contract by 2.1% in tons for 2025, but actually expand slightly by 0.6% in ton and miles.
Lower volume, longer trips.
Seems like it. Q1 exports declined overall, heavily influenced by a nearly 50% drop in Chinese grain imports during that period. Also, the delayed Brazilian soybean season affected early long-haul shipments out of South America.
But it picked up.
Yes, exports apparently surged more recently due to increased Chinese buying, potentially them getting orders in ahead of some U.S. export decision or policy change.
Does that new U.S.-China trade agreement factor into grain forecasts now?
Potentially. Management suggested the recent U.S.-China trade agreement may boost U.S. grain exports specifically to China in Q4, perhaps mirroring the effects seen after a previous trade deal a few years back.
Yeah.
But the overall 2025 outlook for grains will also depend heavily on the strength of China's own domestic harvest later this year.
Right. Always a key variable. Finally, minor bulks, how are they looking?
Minor bulks are projected to show modest expansion, maybe 0.4% in tons and 0.8% in ton miles.
Right.
While broader trade tensions could pose challenges here too, they noted that progress in U.S.-China relations might actually lead to upward revisions for minor bulk trade forecasts. One specific bright spot they mentioned was bauxite exports from West Africa.
Guinea again.
Primarily, yes, continued their very strong performance, expanding by 31% during Q1, and that generates very strong ton miles for the Capesize fleet, those big ships.
Okay, so pulling all these threads together, supply, demand by region, by commodity, regulations.
Yeah.
How did management ultimately summarize their outlook? What was the bottom line?
Well, they stated they expect a, quote, volatile market in 2025, particularly as the U.S. seeks to, reset the global trade landscape. Lots of moving parts.
But cautious optimism.
Exactly. Nevertheless, they remain cautiously optimistic about the medium-term outlook for the dry bulk market overall.
What specifically underpins that cautious optimism? What are the positives they're leaning on?
They cited several key factors. First, that favorable supply picture we discussed, driven by the slow order book and the aging fleet dynamics. Second, the increasing impact of stricter IMO environmental regulations, which should constrain effective supply.
Right.
Third, the accumulation of Chinese government stimulus measures, which they expect will eventually boost their economy and import demand. And fourth, those positive signals apparently emanating from the recent U.S.-China tariff negotiations.
And they also emphasize how they plan to navigate this themselves, right? Their own strategy.
Yes, absolutely. They highlighted their focus on actively managing their large, diverse fleet. They have ships in all size classes to take advantage of market opportunities wherever they arise and continue creating shareholder value, especially in this period of, increased geopolitical uncertainty. Adaptability seems key.
The Q&A session with analysts is often where you get the most sort of direct insights and maybe less scripted answers. An analyst pointed out that the market seems to be in this weird holding pattern. Rates aren't terrible, but not exciting. Yet asset values are holding up surprisingly well. They asked management, essentially, where do you see the market going from here?
Yeah, that's the million-dollar question, isn't it? The CEO responded, apparently quite humorously, by quoting the physicist Niels Bohr, saying prediction is very difficult, especially about the future.
Fair enough.
But he did offer his personal views, breaking it down into the main pros and cons as he sees them impacting the market outlook right now.
Okay, let's hear them. What were the main pros or positives he highlighted?
These were mostly geopolitical and macro drivers. He mentioned, again, increased bauxite and iron ore exports from West Africa and Brazil driving those crucial ton miles, partly because environmental regulations are pushing steelmakers towards higher quality ore, which often comes from further away.
Interesting link.
Yeah. He reiterated that environmental regulations in general will start to bite, constraining supply. He also listed potential reconstruction needs, big ifs here, in places like Ukraine, Gaza, and Syria if conflicts there stop, which could lead to significant demand and maybe port congestion.
Okay, more potential positives.
A potential opening up of Iran could incentivize trade.
Yeah.
Domestically, China boosting its economy is obviously a pro for demand. On the cost side, lower oil prices helping global GDPs and maybe a weaker U.S. dollar, if forecasts are right, could reduce raw material, freight, and even vessel operating costs when viewed in local currencies for buyers.
Got it. So quite a few potential tailwinds. What about the cons or the negative side of his outlook?
These seemed a bit more micro, maybe more industry-specific. He pointed to the risk of China potentially reducing certain imports, maybe coal continues to fall, maybe grain or iron or don't recover as strongly as hoped.
Okay.
The Red Sea opening back up fully, while good for global trade overall, could reduce voyage distances for some dry bulk trades, which is actually a negative for ton-mile demand.
Right, less sailing time needed.
Exactly. He also expressed some concern about the continued limited scrapping relative to the order book deliveries, potentially leading to net fleet growth exceeding ton-mile demand growth. He suggested about 3% demand growth is needed just to offset the underlying roughly 3% fleet increase from deliveries minus scrapping.
So supply could still outpace demand if scrapping doesn't pick up.
That's the risk he highlighted. And finally, a counterintuitive one. Lower oil prices, while maybe good for GDP, could ironically incentivize vessels to speed up, effectively increasing supply capacity in the market.
Ah, the slow steaming effect unwinds a bit.
Potentially.
So his overall summing up for the near term, balancing those pros and cons.
He basically summed it up by expecting a market pretty similar to the current one, maybe following typical seasonal patterns, likely a stronger second half than the first. But he wasn't anticipating, spectacular record-breaking results.
Okay, moderate expectations.
Unless one of those big geopolitical events he mentioned, like a resolution in Ukraine or Iran opening up, provides an unexpected extra bonus to demand or disrupt supply routes favorably. So, basically a moderate year ahead, but with some potential upward optionality if conflicts resolve.
Another key question that came up was about those recent asset sales we discussed, specifically the timing of the cash flow hit in the books, and crucially, what they plan to do with those proceeds.
Right, important for capital allocation. Management confirmed the sales agreements for those 3 Supermax vessels made in Q1 and Q2 mean the ships will be physically delivered to their new buyers during Q2 and early Q3 of 2025.
So the cash comes in soon.
Correct. They expect the total $38.6 million in net proceeds from those sales to be fully received during those second and third quarters.
And their stated plan for that cash? What's the priority?
They were quite clear and direct on this. As long as Star Bulk shares are trading at what management perceives as a meaningful discount to the company's net asset value, NAV,
Which they often do in shipping.
which they often do, their first priority for that incoming cash from vessel sales is share buybacks.
Okay, returning capital via buyback.
Yes, and they explicitly frame this as an arbitrage opportunity. They see it as using proceeds from selling physical assets, vessels, at or close to their NAV, and immediately using that cash to repurchase their own stock, which is trading at a significant discount to that same NAV. Sell high assets, buy low stock.
Makes sense from their perspective if they believe in the NAV. An analyst also pressed them on the persistently low demolition or scrapping rate the industry has seen over the last 5 years, especially when compared to net fleet growth often exceeding ton-mile demand growth. Why aren't more old ships being scrapped if supply is arguably growing too fast?
Yeah, fundamental question for the market balance. The CEO's response was pretty direct, almost blunt. He said ships simply aren't scrapped as long as they're still making any money. Not necessarily a good return, but just not losing cash on an operating basis.
So even a small profit keeps them sailing.
Essentially, yes. Or at least makes them sellable to someone else who can make a small profit. He noted the buyers of Star Bulk's older vessels have recently been Chinese interests, and he admitted he wasn't certain of their specific return expectations or operating cost structures.
Right.
But for Star Bulk themselves, the projected return from keeping those older vessels just wasn't good enough anymore, even with Star Bulk's relatively low operating costs and the fact they had scrubbers fitted to comply with fuel rules. Time to sell.
Will those environmental regulations we talked about earlier, the IMO 2028 framework, etc., finally be the catalyst for more scrapping? Will that force older ships out?
His view was interesting. He thinks the primary effect of the environmental regulations, at least initially, will be to first slow down average vessel speeds across the fleet.
Which we're already seeing.
Right. And potentially cause more delays and costs during dry docks as ships get fitted with new energy-saving technologies or systems needed to comply. He believes that while some older, less efficient vessels, maybe particularly those operating primarily in domestic trades like within China, which might have consumed more fuel, might eventually become less competitive and unprofitable, leading to their scrapping.
Eventually.
The immediate and more widespread impact is expected to be on speeds and dry dock times and costs. He thinks the regulations might ultimately make keeping vessels over 20 years old quite difficult economically, but the scrapping wave, if it comes, will likely follow these initial effects on speed and delays rather than being the immediate first reaction.
So a sequence of effects.
Yeah.
Slow down, spend more in dry dock, then maybe scrap if still unprofitable.
That seemed to be his projected timeline of impacts.
Okay, so stepping back, what does all of this detailed discussion about Star Bulk's call mean for you, our listener, following the dry bulk market or maybe even Star Bulk itself?
Well, this deep dive really gives you a clear, detailed snapshot of how a major player, one of the biggest, is navigating a really complex period in the shipping markets. You get to see the nitty-gritty of their financial performance, how they're actively managing this huge fleet, how they're digesting a large acquisition like Eagle Bulk,
Right.
and crucially, how they're trying to position themselves strategically for the future through things like capital allocation choices, buybacks versus dividends versus debt paydown, and those necessary technological upgrades for environmental rules.
It also gives you management's pretty candid perspective, especially in the Q&A, on the key forces pushing and pulling the market right now. You hear about the supply side dynamics, that slow order book, but still limited scrapping, and the impact of slower steaming speeds.
Yeah, and how that balances against a demand landscape heavily influenced by, uncertain global economic forecasts, the nuances of specific trade policies like US-China tariffs, and those ever-present geopolitical tensions that keep impacting commodity flows and shipping routes.
It really highlights that intricate, often messy relationship between big picture global economics, politics, the increasing pressure from environmental regulations, and the fundamental business of physically moving raw materials around the world, and how all of that ultimately impacts the freight rates companies earn and the value of the ships they own.
The dry bulk market is clearly at a really interesting juncture, isn't it? It's balancing those structural positives, like the limited new builds on order and the potential long-term impacts of environmental rules squeezing supply, with these much more volatile, short-term demand drivers that seem to shift constantly.
Yeah, a lot of it, as Star Bulk's management noted multiple times, seems to hinge on the interplay of unpredictable geopolitical events and just how effective stimulus measures are, particularly the ones coming out of China trying to support their economy.
So as you consider all of this, here is our final thought for today, that outrageous but plausible idea. And remember, we have to say this loud and clear. This is absolutely not financial advice, just a hypothetical scenario based purely on the information discussed from the earnings call.
Okay, let's hear it. What's the idea?
Given management's very clear stated strategy to prioritize share buybacks while they perceive their shares are trading at a significant discount to NAV.
Right, the arbitrage they mentioned.
And their specific plan to use the incoming cash from those announced vessel sales in Q2 and Q3, roughly $38.6 million, primarily for this purpose. Could there be a potential short-term trading opportunity?
How so?
By trying to anticipate Star Bulk's share price, closing some of that gap to its NAV, specifically timed around Q2 and Q3, when that vessel sale cash arrives and the buyback activity might logically intensify.
So betting on the buybacks having a direct, visible impact when that specific cash hits.
Essentially, yes. It's a bet that counts on management strictly following through on their stated capital allocation plan, and crucially, on the market reacting somewhat predictably to that specific anticipated increase in buyback volume funded by those asset sales. It's trying to front-run the effect of their own strategy, based on their own words. Highly speculative, of course.
Definitely speculative, relies on timing and market reaction. But it's based directly on what they said they'd do. Something interesting to mull over, perhaps.
Indeed.
Well, thanks for joining us for this deep dive into Star Bulk's Q1 call. We hope it's given you some valuable insights and context for this important sector.